Hello all and welcome back to Phenomenal UK for another product review. In today's review we're going to be taking a look at Vanguard's FTSE All-World High Dividend Yield ETF, which is an ETF that tracks the performance of the FTSE All-World High Dividend Yield Index, which is an index comprised of large and mid-sized company stocks, excluding real estate trusts in developed and emerging markets that pay dividends that are generally higher than average. We can see the fund has 2.9 billion of AUM, an inception date of the 24th of September 2019, and an OCF of 0.29%. Heading over to Finominal's Fund Analyzer, we can see this is a 5-star rated fund against the benchmark universe of the IA Global Equity Income Index. However, we will actually be using the FTSE All-World as the benchmark selection for this analysis. We're initially looking to headline figures. We can see, as noted, fees of 0.29% versus the benchmarks of 0.21%, so slightly more expensive than the benchmark there. This has come at a lesser total return, 219.22% for the fund versus the benchmarks at 325.58%. A lesser CAGR at 9.26% versus the benchmark's 11.69%. Slightly less volatility though at 12.4% versus the benchmark's 13.6%, though we have seen a deeper max drawdown at minus 28.97% versus the benchmark's minus 25.7%. We can see we've got a lesser Sharpe for the fund at 0.62 versus the FTSE All-World benchmark at 0.75. And noting on dividend yield, so it's going to be a high dividend yield fund, we've got 2.51% dividend yield for the fund versus the FTSE All-World at 1.27%. So higher than the benchmark, I would say a modest dividend yield there. And let's look to performance benchmarking. As we've already noted, seen a lesser performance versus the benchmark, and we can see that illustrated across both charts shown. Let's head over now to asset classes and markets, where, as the initial overview we saw noted, majority in large cap 73%, as well as mid at 16%, and then the residual amount in small cap at 11%. Relatively comparable to the benchmark as well, which we're seeing in regards to sort of similar market cap splits there. Looking to break down by top 10 countries, we can see majority in the US at 38% for the fund versus the FTSE All-World at 59%, so considerably less US exposure for the fund. We have also got increased exposure to Japan at 9% versus the benchmark 6%, as well as the UK at 7% versus the benchmark's 3%, and the residual amounts shown there as well. Moving forward to sectors, we can see majority of the fund is invested in financials at 28.1%, which I would expect to see for a sort of an income producing fund. We've also got quite an underweight in information tech versus the benchmark, with 12.3% for the fund versus the benchmark's 40.6%. Though we've also got a heavy underexposure to the US that may also be attributed to that as well. We can see the other sector exposures shown here, but the main things I would note is a sector bet in financials and a strong difference in information tech versus the benchmark. Looking to risk analytics in regards to risk contribution, where we can see the majority of the risk has been attributed from the global stock markets, MSCI ACWI index at 61.9% versus the benchmark 74.1%. We have also got quite a notable amount in the UK at 20.1% for the fund versus the benchmarks at 6.3%. We've also got some currency risk here, USD, GBP, so cable at 8.9% risk contribution for the fund versus the benchmark's 12.7%, and idiosyncratic risk at 9% for the fund. I'm going to head back over now to the overview tab, as it's worth noting, obviously these CAGR figures include the dividend yields within them. Now, if we strip out those dividend yields, so what the actual fund would have grown if you accounting for actually taking that money out, so let's do 9.26 minus 2.51. We can see after taking that dividend yield, the actual pot would have grown at 6.75%. And if we also look at that of the benchmark, 11.69 minus 1.27 for the benchmark, you can see that would have actually grown at 10.42%. Now, if we kept that amount, if we just invested that capital in the FTSE All-World index itself, to get the same investment growth for the pot that is left over of 6.75%, you could actually sell down units of 3.67% per annum, as well as still keeping that 1.27% dividend yield of which it already pays. And that would actually give an income dividend yield of 5.94%. So just under 5% from having the same amount of actual compound growth in that pot, accounting for taking that dividend out, but having effectively double the dividend yield rate, equivalent income, while also seeing a cheaper fee at 0.21% versus 0.29% for the fund, and also a higher Sharpe ratio as well. So certainly food for thought is what I would say for that one. But that does conclude my analysis, and as always, I do hope that was helpful and informative. And if there are any other funds or portfolios you'd like me to review next, please let me know in the comments. But other than that, thanks all, and please do like and subscribe. Cheers.